Hello and welcome to Stockwatch Live. Company stock watchers are spoilt for choice this week, with the summer results season in full swing. From Games Workshop to Gregg's, Royal Dutch Shell to Royal Bank of Scotland, and Smith & Nephew to Serco, there are half-year, full-year and trading updates aplenty. Let's start with Just Eat, which is due to post half-year results on Tuesday. The big question here is whether UK diners are losing their appetite. Broker UBS has downgraded the takeaway ordering site to neutral from buy after its own research threw up some surprises. After looking at consumer surveys, restaurant inventory analysis and search and app download data, analysts at UBS said 3 surprises drive our more cautious view. These are a trend towards a negative perception of the Just Eat brand in the UK, re-accelerated loss of UK share and worrying search trends in many markets, analysts said. In a note they added, our main concern is that Just Eat is not investing enough at a time when capital is flowing into the industry and customer acquisition costs are rising. They're clearly worried about intense competition in the sector and the fact that Just Eat's first mover advantage may have made it complacent. According to their analysis, Just Eat is likely to miss its soft target of low to mid-teens % UK order growth this year, and is at a risk of losing its #1 market position in France and Spain. Activist investor Cat Rock is already on Just Eat's case, demanding it sell its non-European assets and become more focused, and UBS thinks there's merit in that. Having crunched the numbers, it reckons disposing of the Brazilian and Canadian operations at historical valuation multiples suggests a potential value of 450p a share, or 70% of Just Eat's market value. There's no doubt that competition in the sector is fierce, and I think it's fair to say that some fairly unlikely candidates have taken it by storm. Gregg's started life way back in the 1930s using a van to get its pies, bread and cakes to miners' wives in colliery villages. It's now the 3rd largest brand for out-of-home coffee visits, behind McDonald's and Costa. Chief Executive Roger Whiteside is the man behind Gregg's transformation from a greasy baker, his words not mine, and his £100 million investment in centralised bakeries and improved technology is clearly paying off. January's vegan sausage roll launch, which you might remember resulted in a media frenzy and brought in untold amounts of valuable publicity, has transformed Gregg's fortunes. Sales in 2018 topped £1 billion, and it now has a 5% share by value of the UK's £23 billion a year food-on-the-go sector. Little surprise then that its shares have risen 85% since the start of the year, but on a current price-earnings ratio of 27 times, the company's valuation is very high in sector terms. The task at hand now for Gregg's is to keep momentum going. Mr. Whiteside said that's achievable. Look out for more on that when Gregg's posts half-year results on Tuesday. Now, it's a big week for the banking sector. We have half-year results from Barclays, Lloyds and Royal Bank of Scotland. Barclays will be one to watch on Thursday. Its new chairman formally assumed his role around 2 months ago, but Nigel Higgins has already made his mark with a keen focus on trimming unnecessary costs. Its US business also recently passed the first round of stress tests carried out by the Federal Reserve. But what investors will want to know is whether it's managed to reverse the decline in first quarter pre-tax profits it reported back in April. For the 3 months to the 31st of March, pre-tax profits fell from £1.7 to £1.5 billion, and total income dropped 2% to £5.25 billion, falling short of analysts at Jefferies International, who had penciled in total income just shy of £5.5 billion. Corporate and investment bank income fell 11% for the quarter to just over £2.5 billion on the back of reduced client activity, lower volatility and a smaller banking fee pool across the industry. That, though, beat expectations that income would fall to just under £2.5 billion. UBS has repeated its buy investment rating and cut its price target 20p to 200p. Deutsche Bank is also a buyer, but has cut its price target to 212p from 215p. Finally, we'll get a view on both the commercial and residential property markets, with results due out from estate agency group Countrywide, house builder Taylor Wimpey and commercial landlord Into Properties, all on Wednesday. We've already heard from online disruptor Purplebricks about how tough life is in the current climate. Countrywide, the UK's largest estate agency group, which has seen its shares flatline over the past year and its market capitalisation dip below £100 million, is unfortunately unlikely to have any good news for shareholders. In April, Countrywide downgraded its outlook on earnings after income fell in the first quarter as Brexit uncertainty continued to weigh heavily on consumer confidence and hit demand for homes. It said then that first half adjusted earnings would be around £5 million lower year on year. Previously, it reported they'd be down between £3 and £5 million. That's on the residential side, but commercial property isn't having it any easier. Having completed its joint venture for the Derby shopping centre with Cale Street Investments, Into Properties has used the £150 million raise to repay some of its debt. But that sum is a drop in the ocean for one of the UK's largest shopping centre landlords, which has some £3.7 billion of debt, much of it secured against individual assets, and which will need refinancing by the end of 2024. Into, which has been among the most heavily exposed to the extensive and ongoing woes in the retail sector, has shown it isn't going to take this lying down though. We saw evidence of that when it stood firm against Philip Green's Arcadia Group recently. But the group, which demerged from Liberty International after the last financial crisis, could face its toughest battle yet. Declines in retail property values are pushing up loan-to-value ratios on Into's extensive debt. The company maintains it has significant headroom before it hits the loan-to-value ceilings it's agreed with lenders. But with £9 billion worth of properties in its portfolio, this is going to be a close call if the retail rout carries on. Footfall figures, which give an indication of whether shoppers are out and about, will be important to keep an eye out for when it posts its half-year figures on Tuesday. Footfall across Into's portfolio in the first quarter was down 0.2%, but that was a much narrower fall than the 2.1% seen nationally. Broker Peel Hunt is sticking with its hold rating for now, but has cut its price target from 110 to 90 pence, while Goldman Sachs maintains the shares are a sell and has trimmed its price target to 84 pence. The shares are currently trading around 81.5 pence. And that's all we've got time for, but there are plenty more companies posting results and trading announcements in the week ahead. For coverage of these as they happen, go to the Markets and Insights section at fidelity.co.uk. See you next time.